See ya.
Hello, everybody. It's Wednesday. It's our investment show now. And we're going to go into essaying and discussing and learning, it depends where you are and what's your experience, on the world of options. Uh, what we're trying to do here, we're trying to help people who'd like to take more control of their own investments. It's their own money, and they have to do the best they can in this very, very complicated situation where we are now, both economically and politically, and there are many other aspects that I'm not going into right now. Where you see the connection between politics and investments, and why, if you're doing investments, you cannot ignore politics. You remember a few months ago when there were discussions about sanctions and trade deals with China, and Trump could say that, well, no, there is no deal with China anymore. That's it. So the market would tank 1,500 points, and you have good stocks, and you did your calculation, all your work, how to profit for these investments. In one word, market tank, your stocks went big time down, and now you're in disarray. You don't know whether to sell it, to stop losses, or maybe to get more of the same stock, or do whatever. Um, However, next day he can say, "Oh, everything is fine. The deal is already arranged or close to be arranged, so the market will go up 1,000 points on that day." However, if you were unfortunate enough to sell that stock a day before, you lost your money, and guess why? Because you underestimated the interdependence of investments and politics. So don't underestimate that. However, when we're talking about modern investments, you cannot blindly buy stock on the belief that it will go higher and therefore you'll make money. Because in every situation, on each transaction, there is a buyer and there is a seller. So when you're buying stock, why don't you stop for at least a minute and a half to think? The person or investment fund or mutual fund or whatever it might be is selling that the same stock that you want to buy. Why are they selling? What's the reason? Are they desperate for money? Maybe, maybe not. Have they changed their outlook on that security that you're about to buy? Maybe, maybe not. At least take a couple of minutes to think about that. Maybe you will reconsider your decision to buy that stock, or maybe you will buy half of the positions that you were originally thinking to buy. Another thing is, why not try to use options? Speaking about options, let me try to share a screen with you. So now we are going to see, okay, here it is, I guess. No, I don't see that page. Okay, I'll find it in a sec. However, I don't want to make a mystery out of the options. This is very simple thing. In fact, I mentioned in one of my programs that why there are no courses on options in school or higher education. It's simply because everything what's the risk to learn about options, you can do it in, say, 2, maybe 2.5 hours. Let's discuss a couple of things. First of all, what options are and how they work. What is actually an option? First of all, there is a misconception about the options, what it is, because there are company options. For example, if you were working at Apple, just basically as a um, I don't know, to a cleaner. You were cleaning the floors in their offices. And they gave you an option to uh, secure that you're not going to quit and going to um, do cleaning at the Microsoft or somewhere else. They gave you an option. Let's say Apple stock was at the time, say, $10 a share. So they say, okay, here is an option that in the next 3 years, you can buy 1,000 shares, maybe 100,000 shares, depends on your position. You can purchase 100,000 shares of Apple at $10 in the next 3 years. It's a company option. It's incentive for you to stay with the company and work better. And if stock of Apple went from $10, where it was approximately in about 2002, and it went, where is it now? $350 a share, yeah? And you still have the right. Let's see, okay, in 3 years it wouldn't go to 350, but it could go to probably $50 a share, right? But you have option to buy 100,000 shares at $10. So you would have to come up with $1 million. How to come with $1 million, that's another story. You can borrow, you can share these options with somebody else who has access to this type of money or so on, but that's not for today's discussion. So now at $50, the same $100,000 option, sorry, is worth $5 million, right? So by exercising your options, you will make, with very little effort, $49 million. Can you imagine that you're still continue to work in Apple, you're still doing the floors or so, and however, you have $49 million sitting in a bank account of yours. And actually, there were cases where people didn't quit their jobs, they will continue to work while having tens of millions of dollars in their bank account. Mind you, they had to pay taxes, but that's another story. They're still well off even after paying taxes and not using all kind of deductions and everything else. But we are talking about company options. They're not, as far as I know, maybe there are some exceptions, but they're not tradable options. I mean, probably there are ways around it, but for all purposes of today's discussions, they're not tradable simply because there is no open market where you can do that, to my knowledge. Okay, now we are talking about tradable options that you can purchase and sell any day, anytime while the market is open. So what is really an option in a sense, what I've just explained, tradable options that you can buy and sell anytime? An option you purchase is a contract that gives you certain rights. Now, we are talking about situation when you purchase an option. When we will finish our options discussions, you will understand that you never ever purchase options, you're selling options. But let's discuss it a little bit later when you will understand what the option is in the first place. Depending on the option, you get the right to buy or the right to sell a stock or other type of investment for a specific price during a specific period of time. Okay, to simplify that, let's imagine that you have a house. Let's see it's paid off house worth, say, $500,000. And someone comes to you and tells you, oh, please, I would like to have a right to purchase your house for $500,000 in next 3 years. Oh, you will say, no, I'm not interested because what if the house will go higher in value and I can sell it for $700,000, but you will come to me 2 years later, 3 years later and say, okay, here's money, I'm buying your house and you flip it, or somebody who did that with you will flip it and pocket $200,000. You would disagree with that. But if he will tell you that he wants to buy your house for $600,000 in the next 3 years, you might say, okay, maybe, well, that deal sounds much better. So if he will buy for $600,000, I'll make $100,000. But what's happened if the house is worth $700,000 or more? So I will lose all my profit. So you might, but at the same time, in 3 years, your value of the house may not go anywhere at all. So what you would tell him is that, you know what, I give you the right to purchase house at $600,000 in the next 3 years, so you can make a hell of a lot of money. Maybe the house will be worth $1 million in 3 years. How about if you will pay me some compensation? At the same time, you are acquiring a right to my property at a certain period of time, at a certain price. Why don't you give me now? And there is no guarantee that the house will be going down. Also, if it will, you will also pocket $100,000, which is the difference between $600,000 and $500,000. So you will net $150,000 minus all the usual expenses, some legal fees probably. Well, there are some people who will help you with that. So you will net roughly $150,000 in a matter of 3 years. It's $50,000 a year, and you don't have to really work particularly that hard to pocket this 150,000, 50,000 a year. It's not maybe a bad deal. So okay, so let's see your opponent will agree to that. He'll paying you $50,000, and you have now a contract that he has the right to purchase this house from you within 3 years for $600,000. The deal is a deal, done. Both sides are happy because you are pocketing potentially $50,000 in a spot and potentially another $100,000. Now, the person who paid you $50,000 believes that your house is in very good area, and people are selling and buying real estate like there is no tomorrow, and the house definitely will go higher in price. The only thing is now he needs house to go to $650,000 in value, so to speak, at least to justify his $50,000 investment and $100,000 that he will have to overpay, which is the difference between 600,000 and 500,000. But imagine if his right in house will go to 700,000 or maybe much higher, then he's done a very good transaction. He will make money. You may not be happy at this situation. You would be actually very happy if the house will stay no higher than $600,000. Most likely, he will not exercise his right. So you will end up with $50,000, and you have your house, which went up in a little bit higher in value. So maybe you will find another uh, person who will do similar deal with you, and you'll pocket a little bit more money. That's great. I mean, so essentially, same thing happened in a stock. options. Let's see if Apple today is some $350 a share, and the person believes that Apple will go way much higher. It will go easily to 500 a share, maybe 450. Apple stock, man, and I'd like to offer you something. Okay, I'm all ears. Please tell me what do you want. Okay, here's what I want. I want to have a right to buy Apple stock from you for $355 in next 3 years. Nice. $5 profit, but only if the share will go higher, because if shares will be $354, he's not going to do it. Why pay me 355 when he can buy it on the open market at 354? Well, what's happened if Apple stock will go to, say, $400 a share? That's quite possible. So, but your stock is already out at 355, so you're losing $45 on each share. So if you have 1,000 shares, you're out of $45,000. No, that's not a good deal. So you will ask him, okay, how about if you will pay me some compensation? Because if stock will indeed go to 400 or much higher, or even to 360, I'm losing money or potential profit. So why don't you pay me, I would say, fair deal, $50 a share, okay? And then you can buy it at any time next 3 years. You want to buy it for $400, for $375. Okay, let's discuss that. But $50 right now, right here on a spot, 1,000 shares, give me $50,000, and the deal is yours. So you might negotiate, maybe not 50,000, maybe only 25. He'll give it to you. Then you will say not 3 years, but only 1 year, and not $400 strike price, but let's see, 385, for example. So you can bargain with him and discuss all of that. Okay, that's possibility. That's possibility. However, we're still we're talking about something what in investments known as a call option. A call option gives the owner the right to buy a stock at a specific price. But the owner of the call is not obligated to buy stock. That's an important point to remember. So he has right to buy stock at specific price, but he is not obligated to buy that stock. So let's say stock is of Apple 350, and guess what? It went down to 340. But the purchaser of the right to buy your stock, he is under no obligation whatsoever. Actually, Apple stock can go to $5 a share. He has no obligation whatsoever. He has only right. Okay, so that what calls call option, and the that gives him a right to acquire a stock at specific price at a specific period of time. It's very important point to remember. Now, there are two types of option. One is call option, which we just discussed. We are going to do it at a much more extensive presentation. However, there is another type of option. There is also a put option. Put option gives the owner the right, but again, right, not the obligation, to sell a stock at a specific price. So let's see how you can use it in real life. Put option. Okay, let's concentrate on this Apple stock to make it simpler. It's 350 a share. And now I believe that the stock probably will go lower because of the uncertain environment, the political, economical, who knows what's going to happen. Who knows if Apple may go down to, say, 300 a share. Wouldn't it be nice to have a right, not obligation, just right, to sell that Apple stock at 300 when the stock may go, in fact, to only 250 a share. And all of a sudden, you have a right to sell it at 300, so you have opportunity to pocket $50 per share. If it's 1,000 shares, we're talking about $50,000, simply because you were right in foreseeing the movement of the stocks, that it will go lower in price, and you locked, for some reason. For example, nobody gives you that right. Why would anybody would consider that unless you offered some incentives? For example, if he would tell me that, look, I would like to have a right to sell you that stock at 300 a share in the next 3 years, I would say absolutely not. What's happened if stock will go to 250? And now you have right, and I have obligation to buy from you that stock at $300 while it's trading at 250. That's horrendous deal. No, I'm not going to even consider that. So he will tell you, okay, I understand. Okay, let's what we are going to do. I'll pay you a premium. I'll pay you, say, $25 a share. Apple will go higher. It's a fantastic company, so don't worry. I'll pay you 25 a share. So for 100,000 shares, I'll pay you $25,000. How about that? Oh, that's a different deal. It makes all the difference now. So you think, okay, I'll pocket $25,000. Stock will not go to 300 or 250 or whatever. It will go to 500. Okay, give me your money. Excellent. We've done the deal. Everybody's happy because he now is happy that he has a right to sell you stock at 300, which is trading at 250 or who knows, maybe much lower. And you, because you believe the stock will go much higher, you just pocket $25,000. And now, as soon as coronavirus will be over, you will take a trip around the world. And you're both happy now. You're happy, and your purchaser for $25,000, he acquired a great right. So he's also happy. So everybody's happy now. The deal is done. But what's really happening in the real world? In the real world, options started traded in Chicago Board of Trade in 1973. So there is a huge, enormous market for all calls and puts, and it's on any stock like Apple or all the other well-known stocks and not so well-known stocks. And the market is very efficient. There is every second, or a fraction of a second, if you will, there is a bid and ask for any option. What that means? That means that you don't have to negotiate whether you want to get $25,000 or $26,000, and your opponent will say, no, I'm going to pay only $21,500. There is no such thing. The prices are bid and ask, and on things like index or even Apple stock and some really liquid stocks, they are calibrated into fractions, sometimes even 1 cent, for example. That's a difference between bid and ask. So the options are very liquid. They're easily bought and sold at any time. Let's see, you bought your put, for example, and then Apple went up in price and you feel that your put will expire worthless in 3 years. So you say, well, you know what, I made a mistake. I will lose $25,000. I still can save 15, maybe even $20,000 by admitting my mistake, go to the market and sell your put at certain loss, unfortunately, but you still recover most of the capital that you've invested, and so you can go to another deal. But the person who sold you that put, yeah, he will probably will be happy with a smaller profit, but there is no risk any longer. There is no risk that stock will go down to 250 and you will incur losses. However, there is no negotiations. There is a market makers that operate all type of option trades, and therefore you don't negotiate that I want to sell my option for $20,000 or $15,000 or so on. There is a bid and ask at any given time, so you will easily exercise one of these positions. So we have to remember for now, for all practical reasons, there are two type of options. Calls, you remember what calls are. Calls give you a right to buy stock at specific price during a specific period of time. And you have only right, if you purchase the call, have right, no obligation. So you purchased a call, you purchase a right. You have no obligations whatsoever. The person now who sold call, now he virtually has no rights, but he has, because he's collected money, that's what his right. He collected money. Isn't it nice? I think so. I do it every week. But he has obligations. Here is the exchange. He collected money, but he acquired obligations to sell you a stock. The same Apple stock went to $500 a share in next, say, 12 months. But you have obligation to deliver your stock. Let's say you sold a call, let's say $400 call. Stock is 500. You still have to deliver your stock 400 a share. Now, with the put options, the owner of the right, the owner of the put, he paid money to acquire the right. But again, no, just the right to sell you a stock. It could be actually not even stock. It could be index, for example, S&P, so-called SPY, for example. Now he has right to sell you stock at predetermined price, but he has no obligation. Now, if you sold him that right, now you have obligation to purchase from him the security, for example, Apple, at 300 a share if you sold that particular option, a put, even if the price went to 250 or, God forbid, 250. So you have certain obligations. Not a pretty situation if that's what's going to happen, but you were paid money. Here is an exchange. You sold somebody the right to sell your stock at predetermined price, let's say at 300, for example. Or it could be, he could sell you even, he could acquire for the right to sell you at, say, $325 a share. And you would have to deliver the stock at that particular price. Now, so in a put, same as in a call, you have two sides. You have a purchaser of an option, say call, for example, and you have a seller of an option, which is also a call. And the same thing on the puts, you have a purchaser of a put and you have a seller of a put. Now to understand a little bit more about this, let's talk about certain thing which calls time. Time is probably the most important component of option trading. What that means? When somebody bought a call, right, to purchase shares of Apple, $400 a share for the next 12 months. He paid certain premium to do that, okay? Now, let's say stock is not moving anywhere. And it's at 350, it goes up to 360, down to 340, but staying around this price for some time. Let's say for next 3, maybe 4 months. What's going to happen with the price of an option? Well, guess what? Since you already have only 8 months, if it's 4 months already passed, you have only 8 months left for a stock to go higher in price to 400 or even higher. Actually, it should go higher in order for your call become profitable. Oh, there are some bad news for you. During these 4 months, your call is going down in value. Let's say you purchased it for, say, $50, just to make it simple. You bought it for $50, and in 4 months, nothing really happened there. Your call most likely will not cost $50 as when you purchased. It will go down to, I'd say, maybe $32, maybe less. So now you're losing money if you will close your position. However, let's see, you think you're still right. Some people I've heard even averaging down, so they're buying more, another thousand. Sorry, I forgot to tell you about calls and puts. That one put, same as one call, carries one lot of 100 shares. So if I'm talking about one call for Apple stock, one call is equal 100 shares. So if I bought one call today for Apple, it means I have a right to acquire the stock from you, and we're talking about 100 shares. If I bought 10 calls, I have a right to acquire 1,000 shares. So let's see, some people, for example, they bought, say, 10 calls for Apple stock. So it went down from $50 to $30 a share. And they think, oh, if it was a good deal at $50, it's a way much better deal at $30. So I'll buy for $30 another not 1,000 shares, but 10 calls. 10 calls will give you right to acquire 1,000 shares. So now you have already 20 calls representing 2,000 shares. Your average price is $40. Is it a good deal? Hard to say, because we don't know which way Apple stock will go. Maybe in next half an hour it will go to $385 a share, and he'll make actually a lot of money. It may not happen either. Actually, it may go down to $325 a share, for example, and even it will stay the same 350 for the next few months. Now you are losing a lot of money. We are talking about 20 calls, and you pay $40 your average price. Oh, you're losing now $80,000. Am I right? Only eight. Well, it's a kind of a tragic development, really. However, it's very happy development. It's fantastic development for someone who sold you. It could be actually not even a real investor. It could be a money maker. It could be a, let's see, market maker who is dealing with Apple options. For him, it's an excellent deal. By doing nothing, taking some risk, but his risk only that he would deliver at $400 shares, which cost him only $350 at today's prices. However, maybe he acquired Apple when it was only $150 a share. So he may be somewhat limited. He limited his profit potential, but he was paid cash. Don't forget for this. So that's not such a bad deal for the market maker who sold you, or investor. For example, if I have, say, 1,000 shares of Apple, and I will sell today 10 calls, I will have to deliver my shares at $400 a share, while stock may be 450 or even 500 or maybe much higher. So I limited my profit potential, but I locked in this profit, plus I was paid to do so with very little risk, if any. My risk is only if I collected, say, 40, 50, say $40 for each call, $40, right? So let's see if Apple stock will go down to from 350 where it's today to $310. Guess what? I'm not losing any money because I was paid $40 for a call that I sold. Now, if stock will go lower to 310, then I'm incurring some losses. However, I can still hold on to the stock. It may go higher in price. Also, I may sell more calls. Not at $400 a share, but let's say $350 a share to generate more opportunities for me to make money. And this way, I have a good stock, Apple. There's not many stocks better than Apple these days. And I'm collecting premiums that people are buying. Okay, now in all history of option trading, there was only, I'm talking about 1973 when it all started, until today, year 2020, if I'm correct. There was only 1 year in all history of option trading where purchasers of options, both calls and puts, beat the sellers. The year is 1987. Anybody remembers what's happening in 1987? Yes, Black Monday when Dow Jones went down in one day 22%. So people who would buy a day before Black Monday or a week before Black Monday or even a month before, if they would buy puts on the index S&P, at that time it was OEX was very popular option vehicle. So if somebody would buy 500 way out of the money puts, we'll discuss out of the money and in the money or so on. That person would make a killing because he could buy some fractional, some little puts paying maybe 50 cents, maybe even lower. And he would buy a lot of puts. And after Black Monday, they would multiply in value. They would cost, instead of say 50 cents, they would cost probably $50 each. And he invested a couple of $1,000. He would make a killing. He would walk away with $200,000. So we're talking about 1 year in 47 years. So we're talking about 46 years when sellers of the options made the money, and only 1 year out of 47 when purchasers made money. Very important thing to remember. So when you are thinking about buying options, either calls or puts, knowing that in 46 years out of 47, the purchaser lost money. Very interesting propositions. So you're working mathematically in a proposition where in 96% or so, you will lose money, and 4% that you're going to make money. Well, you definitely need help. I'm pretty sure medical help, which hopefully somebody will provide for you. Unfortunately, I'm not a doctor, I can't do that. But hopefully you'll find the right professional who will help you. So, in what we are going to discuss today and next week and next month and next 10 years, I hope, we're going to discuss never, ever buy options. Although, I must confess that in the markets like we have today, it will be very profitable at the end of February to buy all kinds of put options on index, on Apple, on just anything, and you would make a hell of a lot of money. I must admit that. I wish I would do that. I didn't. But you could. You could make a lot of money. Now, once market went all the way down and started to recover, That would be a pretty good strategy to buy calls. You would also make money, not as much as if you would sell puts in February, but you would still make pretty good money. But who would guarantee you that that scenario will take place? So it's very speculative scenario. You could probably, if you, if you are following the strategy 90-10, you see your 90% of your investments are in solid stocks, bonds, and most likely they will generate 10% of profits. So your other 10%, it's like money that you can really gamble. Let's see, you can go to Las Vegas probably. I don't know if it's open already, but if it will be open soon, okay, you can take this money, go to Las Vegas, you can buy lottery tickets, you can bet on sports. There are no sports today, although European soccer is doing pretty good. Actually, I've made some bets in the last few days, pretty good. And yeah, you can do that. That's. But you know what? In Las Vegas, in sports betting, you have much better chances than buying options. So why don't you do that? Okay, take your 10%, 9% you can go to Las Vegas, do anything, and 1%, just 1%, take a pleasure to lose some money, buy options, puts, calls, anything, whatever will come here. And if you're lucky, because there is still 4% chance that you're going to make money. Why not? If you do that 100 times, so 99, 96 times you will most likely lose money, and 4 times you will probably make money. And this 4% may, just may, generate all the losses that you incurred in 96% that you lost money. You know what? It's not so bad. Now, if you'll make even more, then probably you will offset all your other 96% of losses and you will walk away with profit. Fantastic. You know what? Maybe I'll do that one day when my wife would allow me to do that. I have some discretionary funds, not much. Maybe I'll try to do that. However, knowing that my chances are 4%, somehow it's very difficult to convince myself to do that. Okay, I'll have to work. I'll have to probably be more brave than I am, although it's difficult, but I will try. So now we have this opportunity to understand the options, and I promised to talk a little bit mm, about talking on time value and also in the money or out of the money or at the money. Oh, there are 3 things. Okay, let's discuss one thing. Okay, if that's very simple, even I can understand. If you're talking about, let's see, same. Oh, you know what? The hell is that? Okay, let's talk about um, gold. Gold is it's a physical gold, of course, we all know that, but it's also a symbol of a company, Barrick Gold Corporation, which extracts and sells a lot of gold. Their shares are now worth, last time I looked at, was it $26 a share, for example? Okay, let's see. We know what, $25. Maybe it went down after I started my program. So let's see, it's $25 a share. I own stock. I own 5,000 shares. Let's see. Let's see. Let's see. Obviously, I want to sell somebody calls. By the way, the calls that I'm selling are covered calls. What means covered calls? They are covered by the stock that I own. So I'm not scared that the stock will go through the roof. All of a sudden, Barrick Gold will become $50 a share or $5,000 a share. I don't care because I have the underlying security to deliver. So I'm not going to take a financial ruin because the stock went so much higher in price and I have to deliver and I don't have the stock to deliver and now I have to sell my house and declare bankruptcy and go through the horrific situation. No, I'm not going to do that. Mm, so I have underlying security. My call is then covered. Okay, now what kind of calls to sell? So obviously, if I will sell out of the money calls, out of the money means that these calls, the strike price. Strike price means the price that allows buyer of that security to exercise it. Say $30 a share. And the expiration is in next 3 weeks. I don't think that anybody will pay any serious money, maybe 5 cents, maybe even less for that. But I'm there to make money. Also, sometimes I feel very greedy. It's not a nice thing, but sometimes I really do. I really do. That's one of my shortcomings. So I want to sell then, maybe not in next 2, 3 weeks expiration, but maybe in 2, 3 months expiration. Now, the more time I'm selling, more money people will pay me, which is good. So let's see, I'm selling, I can sell even 1 year expiration. I will get way much more money. And what if I will sell not $30 call, but only 27.50 call? Well, now we are talking about some serious money coming up my way. I love it. Actually, once I'll finish the program, I will do exactly that. Uh, but there is something else I can do. It's still out of the money because the stock is only $25 and I'm selling somebody right to purchase it at 27.50. What if I will sell somebody's call at the money, which is $25? Now, obviously, I will get way much more money for this option, for the calls that I'm selling. The only problem is that I'm selling essentially all upside on my stock. I'm collecting more premium as a compensation for that. But if I believe that the gold will go to 2,000 an ounce and higher, I would love to hold on to my barrick gold shares. So now I'm really have to make a hard decision which option to sell, which call to sell, at the money or out of the money. However, there is still another scenario. What if gold is going down in price, which happens sometimes, more often than you think? So maybe to lock my profits, let's say I acquired barrick gold a while ago, my price is $20, so I don't care as long as it's higher than $20, I'm fine. So if I believe that the gold may go lower in price, so I would be wise to sell not out of the money, not at the money, but in the money, which means a price lower than today's price, $25 a share. So I'm selling 22 and a half. And if I'm selling it with, say, 12 months expiration, it's incredible. I will get tons of money for this calls that I'm selling. So I'm of course, basically I should resign to the fact that I will have to deliver, most likely, I will have to deliver stock at 22.50, which costs today $25 and has way more upside to go. Why would I do that? Uh, to protect downside if the stock indeed will go lower. You know what? I really don't like the deal. I'm not going to do that. No, no. Okay, so in this situation, what I would recommend is, first of all, get down the concept of calls. We will talk about puts next time. I've indicated what they are, but puts are just as an incredible vehicle to make money, just as calls, but from different perspective. So the calls are, if you sell them, you get obligation. You have no rights, actually. And actually, a few times, what happened to me, I like dividends paying stocks. Again, only because I'm greedy. There is no other reason. I like dividends paying stocks because there are three um, profit generations, profit generators. One is the stock itself. It can go much higher than where you bought it. Nice. Number two, it's paying you dividends. And today, there are several really good stocks paying 7% dividends. It's incredible deal, 7% dividend. Okay, and finally, there is another profit opportunity for you is to sell calls against your position. What happened to me a few months ago, I had the stock of Canadian Imperial Bank of Commerce. It's paying nice dividends. It's a very stable company. I was collecting dividends. The stock was going higher in price, and I sold covered calls. You know what's happened? That someone who bought the calls exercised them, which means that I had to deliver the shares. I didn't really have to do anything. They were simply taken away from me. So I was exercised. And it's happened 2 days before dividend payments. Uh, yes, I made money at the end of the day because I sold the calls and the stock went higher in price, and I've collected some dividends. But that one dividend that I really counted almost like in my bank account, and I was thinking about how to use this money, that was taken away from me. That's another unfortunate thing. They're calling about being exercised. So somebody who bought the right, let's see, CM is a symbol for Canadian Bank of Commerce. CM was trading at 85 dollars a share or something, and I sold 80 dollars call, so I got the premium. And stock went. I bought stock at $70 a share. It went up to 85, but it was taken away from me 2 days before the dividend payment. That's that's a dark side of selling calls, especially on dividend-paying stock. But no regrets. No regrets. What's happened? It happened. Somebody got even greedier than me. So somebody wanted to collect this dividend and exercise his right. So he collected dividends, not me. Not very happy about that. Still not happy. But that's a good lesson for you. Don't count your eggs because something may happen. Something something can be exercised. That's a lesson about that. That happened to me first time. I actually after that it happened to me the same thing with the Bank of Nova Scotia. Same thing. It was taken away from me 3 days before the dividend payment. Okay, so I know the game. Um, but that's fine. That's fine. You're just still making money. You're still happy, and that's the only thing what you should know. So about calls, use strategy of covered calls. It's a very sound strategy. If it generates, um, probably not in every market, of course. If market will go down 50%, I don't think that you will be very happy about that. But hopefully it's not happening very often. 50% downside. We're talking about historical event, which happened last March. It happened in 2009. Happened in 2000 when the dot-com bubble burst. A few more times. So it's happening, let's see, once once a generation, probably once every 10 years, you may say. Okay, so that's unfortunately that's something what you have to bear in mind. So you have to always defend your positions. You have to always be mindful that there are certain forces. The president can say that there is no more deal with China, as I said before. Market can tank on that news, and then he will say that there is no more deal with Australia and New Zealand and Russia and France and Canada and so on. So market will go down another 350 points. Okay, that's a fact of life. That's an environment where we are now. Let's learn how to live with that. And of course, there is an election coming up in 4 months, so situation may change. Either way, in 4 months, market can go down same 50%. It could go also up 50%. So um, I wish you will have some questions, please send it to IBM TV investment program. I would be more than happy to answer them. Good luck with your investments. Don't rush to invest yet. We have to still discuss a lot of things about puts, then more about options. Then I'll show you some examples how to trade these options and how to secure your positions. In the meantime, I wish you all the best. Goodbye and see you next week. Thank you.